I now want to bring in the chief global strategist at Freedom Capital Markets, my good friend Jay Woods, graciously taking time out of a very busy media schedule these days to join us here at Common Threads. Jay, welcome to the show.
Hey, it's always good to be with you. I'll never say no to you.
One of the top headlines this week, the S&P 500 hitting correction territory. Jay, does anything in the stock market right now particularly worry you?
Well, I mean, each headline seems to worry us more than the next. We are at headline risk like I've never seen. I call it the tariff tantrum. Every time you think okay, it's not too bad, then something else comes out and you sell off. We've been getting some kind of good economic data, and it doesn't matter because these tariffs are what's on everyone's mind, the uncertainty in this market. So it's a little trepidatious. Now we're corrected 10%. And, when you see these things happen, you live through them, it's never fun. But historically, we've seen things like this, maybe not with the headlines behind it, but, you have to put these things in perspective and deal with one headline at a time. And from a market's point of view, try to block out that noise.
What is it? You know the stats better than I do. We usually get 5% pullbacks a year. Is that right?
35% pullbacks on average a year, one 10% correction just over a year. We hadn't had one in quite some time, almost 2 years. So this, hopefully this is your garden variety 10% correction. It doesn't feel like it right now as we live through it. Down 17 trading days, we've dropped 10% in the S&P 500. It's been a quick one. Let's see how much more we have to go. There are a couple things that have got me optimistic that we're at a tradable bottom right now.
What makes you optimistic in this market right now as we see a lot of red on the big board, Jay?
Yeah, well, let's break it down. Consumer sentiment, the AAII consumer sentiment is reading extremely bearish. For 3 weeks now, it's been over 55% bears. We haven't seen 3 weeks at that high level since when? 2009. What happened after 2009? Oh, that was the bottom in the market, and we went on an epic run. And then from daily basis, we haven't seen it this low or this high on the bear side since September 2022. Well, October 2022 is when we began to run. So it's a contrarian indicator. When you see that, you want to say, you know what? I'll take the other side of this. People are fearful. People are panicking. And then when you look at the indexes themselves, when you look at individual stocks that are down 20% in a very quick manner. The S&P 500 down 10%. The NASDAQ 100 down almost 14%. They are oversold. The RSI indicator from a technical point of view is reading under 30. It doesn't do that very often. When it does, it's considered oversold. And that doesn't mean it's going to stop, but it means we're near a potential level, a landing spot, if you will, and possibly reversal. So there are still a few things I want to see. I want to see the VIX spike over 30. I want to see outright fear. We haven't gotten a VIX spike of that magnitude since August. And then I want to see just a little more of a washout. I want to feel panic. When I see you on the floor, it's kind of orderly. I want to see a little chaos, a little fear. And that, as a former market maker down there, that's when you really want to dig in. But we're getting close to what I think could lead to a snapback rally. Does it mean it's all clear? No, but it could be a tradable bounce.
References to the relative strength index are always welcome on the show, Jay Wood, so I'm grateful for that. What should investors most keep in mind whenever they see the stock market selling off in response to Trump's tariff policy?
Yeah, it's hard to block out that noise, but you have to. These tariffs are just, it's unpredictable where they're going to go. I mean, Canada is now like our enemy. What is going on in the world? So I just look at price action. I look at these stocks from a fundamental point of view. I look at what the financials have done. Nothing has changed with Goldman Sachs or JP Morgan, but they've given up 20% from their peak. Maybe they got a little too euphoric with the Trump election, but, the path going forward looks good. To me, some of these mega cap names, those Magnificent Seven, they are getting beaten down. And you want to basically, when you go through something like this, have a shopping list ready. Where would I buy Apple? Well, I look at it technically. It's getting to a point where it's oversold. It's if it gets to 200, it's at 209.68. I love your live charts here. This is an area of interest where I would take a shot. I could take it a shot as a swing trader, or from a long-term basis, I would buy that. Amazon broke 200. I don't like that it just broke 200, but if it gets into the 180s, it's at 193-ish right now. Amazon, for a long-term investor, these are the opportunities you want. NVIDIA, we talk about way too often, but it had 320% corrections last year. It dropped 30%. It's down 25% from its peak, while we're filming right now. But it could rally back to its 200-day moving average. That would be another 12 points higher, about 10% from where we are. So there are tradable bounces, and NVIDIA looks like it may be on its way to going back up, but doesn't mean it's all clear. It's just going back to its new downtrend, its 200-day moving average from below. But we do have an event next week with NVIDIA, so it wouldn't shock me to see a little more of a rally over the coming days. But these are big names that we all know. Everyone trades these stocks in the day trading, swing trading community. And long-term investors have this in their 401k. So you got to know these stocks. And when they go on sale, which I believe they are, you want to get ready to buy some of these. And then if you want to play defense, then you go to some of your boring stocks that pay nice dividends. You go to Pfizer, which hasn't done anything in years, but it'll pay you a nice dividend. AT&T doesn't look too bad. Good dividend. So it depends on your time horizon, your pain threshold. But to me, when I look at it, I'm seeing a few opportunities, at least on a near-term basis. And if we get a washout and we go a little lower, I think this is just that correction in the secular bull market, and we should take advantage of it.
Jay, recently I've heard several new nicknames for the Mag 7, including the Lag 7, the MAGA 7, given the bump after the election, the Maleficent 7. Is there another name for what we traditionally call the Mag or Magnificent 7 to better reflect how those names have been trading, I wonder?
Wow. I don't pay attention to the nicknames. I just look at the stocks, and, I thought Broadcom, which is symbol AVGO, was going to join the Mag 7. Tesla doesn't even belong in there. But who knows? Elon Musk can say something. He can go back to work, at least at Tesla, and maybe the stock rallies 10 to 15% in a day or two. So no, I have no funny names. I'll leave that to people like you and the headline writers and Jim Cramer to come up with those cool acronyms.
Has the market digested or priced in the possibility of a government shutdown that could happen in the next few days? And what historically has that looked like for the market?
Well, that's a great question. And that is another one of the angsty things that's hanging over the head of investors, where they're just like, you know what? I can't take these headlines. I don't know what's going on. I'm taking money out of this market. And government shutdown. Well, let's talk about government shutdown. Historically, it hasn't had that big of an impact. There was one time recently where it did, and that was 2018. Who was president? Oh, yeah, Donald Trump. What was the backdrop to the government shutdown back in December of 2018? It was tariffs, trade war. The S&P 500 sold off over 10% the 2 weeks going into it, almost 8% the week leading up to the shutdown. We shut down on December 22nd. Next day we opened for trading. We rallied. The next 5 days, we made back about 4.5%, and we made back all of that lost during the 35 days of that shutdown. So usually the trader and me, you buy the sell-off going into a shutdown, and you get the rally as the government actually shut down. But no one wants to live through this. No one wants to go through these headlines. They use it as a political football to get their talking points done. But from a market point of view, under Donald Trump 1.0, it moved markets. Right now, under 2.0, we're down 4.5% this week. So it's very similar to what we saw the last time, and it's over 10% now from February 19th high. So, yeah, this can be put in the category of why we're selling off, but I think you want to buy this dip, and that's another reason. We shut down, yeah, it's going to be, big headlines, but guess what? It may be baked into the market, so we want to buy that dip.
You may be an Eagles fan, Jay Woods, but you're truly one of the best people I know in and around the New York Stock Exchange community. I do want to thank Chief Global Strategist at Freedom Capital Markets, the great Jay Woods, a good buddy of mine. Enjoy your weekend. Thanks for being here tonight.
All right. Thank you, JD. Have a good night.